So now we have seen how we use technical indicators and how we read the market. Now it's time to add a new exciting approach, a quant technical approach. Have you ever felt lost when looking at the chart, not knowing which side of the trade to take? Have you lost money on false pullbacks or trend reversals? And how many times did you make too many trades because you believed your idea was right, but the market simply did not react? This is called revenge trading and can be very dangerous. This is why we are introducing you to the MenthorQ levels indicator. Let's look at this chart. This is a chart of Nvidia. During this time, there was a strong momentum on the stock. The stock almost reached $1,000 in the period, and then we saw a pullback. What would you do? Would you go long or would you go short? If we simply use technical analysis and other indicators like support and resistance or RSI, we might consider going long at these levels. Now, we would have been wrong and we would have lost on the trade. What if you knew that most market participants were protecting themselves on that level? They bought a lot of put options to protect from potential losses. This is where understanding the option positionings comes into play. This is the MenthorQ net gamma exposure chart showing market positioning on the stock. The red bars highlight a large amount of put positioning. This brings us to the basics of options. A put option is basically a safety net or an insurance that allows you to sell your stock at a predetermined price, even if the market price continues to drop. And what if you knew that on the other side of the trade there is a market maker that provides the price? Market makers are key to the market. They are always there, ready to buy or sell stocks or options, ensuring that there is always enough liquidity to keep the market running. In the case of options, the majority of transactions are executed by a market maker. Market makers don't really care whether the price of a stock goes up or down. The market maker does not make money from trading, but from executing trading volumes and charging a bid-ask spread. This concept is really important. So by doing this, market makers take on the risk in case the price of a stock moves. But they don't really want to gamble on whether the stock will rise or fall. Their job is to facilitate trades and provide liquidity. So if a lot of investors start to buy put options because they're worried the price of a stock might go down, what does that mean for the market makers? Well, if the market really starts to fall, all these investors will want to use their put option to sell their stock at the higher price, which could potentially put the market maker in a tricky situation because they have the obligation to buy these stocks at these prices. By selling put options or the insurance, market makers are now forced to buy the stock at higher prices. If the market keeps dropping, they might have to buy a lot of stocks at prices much higher than the market value, which could mean greater losses. To protect themselves from losing money in this scenario, market makers use a strategy called delta hedging. In the simplest form, that means that the market maker is always hedging its portfolio. As we said before, they are not making money on directional movement, but by executing trades and charging the bid-ask spread. To hedge against movement, they delta hedge their portfolio by buying or selling the underlying asset. This topic can be complicated, but we have a free documentation within our website under the resources section. This activity is like their own insurance. It allows them not to lose money when the market falls. They do this by making their own set of trades that balance out the risk they are taking when they sell put options. If the market drops, these balancing trades help them not lose out because they have other positions that gain value. They want to keep a risk-neutral position. This concept can be quite complex, but in simple terms, knowing where the market is positioned on the put or call side allows us to identify those reaction zones that will become very important as the price approaches those levels. We know that if that happens, those options that were previously out of the money are now in the money, and the market makers will react to protect against losses, and these reactions could add or remove liquidity to the market. Now let's go back to our Nvidia example. And what if you were able to plot these levels on a chart together with your favorite technical indicators? This is now possible with the MenthorQ levels indicator. We are able to take data coming from the option market and plot it on a chart to help you make sense of complex information. This will help you make smarter trades and simplify your visualization. We can now add those reaction zones directly to the chart. Complex data is now simplified, giving traders a clearer picture. In this example, our put support level would have given us a very strong signal for a long trade. Our high vol level, or HVL, could have been our profit target for this trade. Stay tuned as we will explain what these levels are and what they represent. But what if I wanted to stay in the trade? We can add the levels for the next day and see the change in positioning. We see a potential target at our core resistance level or one-day max level. The price breaks the gamma wall with a strong momentum and reaches the one-day maximum level. So now what do? Do we wait for more upside or do we close our trade? What if you had some backtesting results that show you that the price of Nvidia closes below the one-day max level on 90% of the time? Would you still keep the trade or would you close it? You can find these results on our website. So let's see what happens next. The price in fact retraces back right on the 1-day max level for the day. So now you are no longer trading blind, you have data that support your decisions.